Welcome to the What to Watch video update. This is a weekly video where it's the last video that I prepare over the weekend. And I go through and I look at the charts that are looking somewhat positive, those that are looking negative, and then those other areas that I'm just keeping an eye on that are neither positive nor negative, but just areas that we need to watch. And there's not a lot on the positive side right now. Friday's down move really did a lot of damage. We're back down to support that it was already tested, and it looked like we had successfully tested that area, but now we're right back down here again. And so we have to ask the question, is the bottom in for the S&P 500? Or to phrase that a little bit differently, are we just getting started with more of a decline? And this is being prepared for Monday, March 31st. On the positive side, first of all, even though we're looking more negative right now with the S&P, the advanced decline line's holding up fairly well. Now, this would suggest that there's rotation going on. It's not money coming out of the market. It's just going from one part of the market to another part, from an offensive side where we're getting ready to go higher to a defensive side where we could be getting ready to go lower. We've been watching that for quite some time now. And then we see a few days where we might be drifting back over to the offensive side, only to have a down day like Friday and wipe out all of the improvements that we're seeing and then turn back more negative. But when you look at this, it's still above this moving average, both based on price and volume. It went down a bit on Friday, but we're not seeing a real negative move with this chart. And it's a similar thing here with the advancers decliners over a 10-day period. This is an oscillator where we've been spending a lot of time around the zero level without getting extreme positive or negative. Well, we started to show some improvement and then we came down in Friday's session, but we're still above zero. We're seeing pretty good numbers here with another internal measure of the S&P, the new highs minus the new lows. And these are 52-week new highs and new lows, where we're seeing more green than red for the most part. And so our 5-day moving average is going up, and our 10-day had been going up, and now it's starting to level off. But if we were turning more negative, we would see a whole lot more red and a whole lot less green. But again, this could suggest that we're seeing more rotation because there are stocks that are setting new highs, and then maybe there's stocks that are more value oriented rather than growth oriented. And that's why this appears to be holding up for the time being. We're also going down as far as the VIX momentum, but we're starting to turn up with the MACD. We're back above 20. Of course, that's a negative for the VIX. And if we keep going up, this is starting to turn up with the MACD, and it would cross back above the line and actually switch to a positive momentum. We want this to go down, and the fact that it's going up is negative. So, but for right now, we are still positive in that the momentum is to go lower with the VIX. Accumulation distribution. It took a hit in Friday's session, pretty much like everything else, but we're still above the red moving average. We don't go negative until we actually cross below the moving average. Now, you might differ from that. You might say, well, look at the context. We were going up and now we're coming back. Okay, you could go with that. There's some other smart money indicators that we look at where I do use that approach. This one is, I use a little bit broader definition where it's either above or below the red line. And since it's still above the red line, it's considered positive. We're still positive with momentum, even though we're starting to take a hit. We were showing some improvement throughout the week, nothing all that great, and it was vulnerable. Well, that vulnerability really got taken advantage of in Friday's session. But when we look at our two short-term oscillators, we're still positive. We're still going up with the slope. We're starting to turn over a bit with the TSI, rolling over a bit with our three intermediate-term oscillators, and just starting to go positive here with our long-term oscillator. So getting a bit of a mixed picture there, but this is still looking positive for the most part. And also the Copic curve, another momentum oscillator, continues to be positive. And even though we're just 5 points above it, which is really nothing in S&P 500 number terms, we did close above this pivot point. The pivot point's at 55.77. We closed at 55.80.81 in Friday's session. So on a weekly basis, this is a weekly chart. This is still holding up. We drop down below this, and especially we won't really know until this coming Friday. If we close below that, that's going to turn things more negative longer term. But for right now, this long-term support is holding. The momentum for the NASDAQ 100 is positive, but starting to roll over. And we're still looking positive here when we look at the Qs, which is the NASDAQ 100 to the small caps, IWM. And it's not that the Qs are doing all that great, it's that the small caps are doing terrible. That's keeping this ratio pretty high. And we're still above this blue line. That's considered positive for the time being. And we're coming down, but we're still just a little bit above the red line here when we look at the NASDAQ 100, which is growth, versus the Dow, which is value. But even though it has some growth stocks in it, this is not falling apart, at least yet. So we're hanging on to the positive side of this. Now, that's all the positive side. Now we have quite a bit of negative charts. Since we had a down week, I put the intraday chart over on this side, and things were doing okay. Not great, but not terrible until we got to Friday's session. Core PCE came out, it got rounded up. The market decided to freak out over that. And we had consumer sentiment come out that was negative, and we didn't have much of a lower open, but then we just saw massive selling going below S1, S2, came all the way down to S3. That's why I really stress using these pivot points. I post them every day for the ones for the month on the YouTube community tab, and I also post them for that particular day, which would be these pivot points. Now, the ones that are pre-calculated only go to S1, S2. I use a pivot point calculator to come up with S3 and S4. That's as far as I've ever found calculators going with this. But you notice this is right where we bottomed. And so knowing these particular pivot points could be very helpful. Even if you don't may not day trade. I don't day trade, but I watch this chart for what's going on inside of the day because we can get some real clues as to what's happening. So feel free to check those out. Then looking at the short-term trend, I use a thing called the ADX, the average directional movement, to measure that. Now we are showing a weakening trend. Now the black line going up or down, that's not telling us direction because you notice the ADX was going up as the S&P was coming down. This measures the strength of the trend. And when this black line's going up, that means the trend is getting stronger. We get a little bit nervous when it goes above 40, and you notice we got up a little above 50 and then started to roll over, and we're dropping below the moving average. That's why I say it's a weakening trend, but it's still a trend as long as we're still above 20. That shows us the condition of the trend. Now, what do we get for direction? Well, the red line, that's selling. The green line, that's buying. The red line's going up and the green line's coming down, and the red line's above the green line. So that tells us the short-term trend is negative, but it is a trend, but it's a weakening trend. Same thing here with the intermediate term. The ADX is below the moving average. The red line's on top. The green line is going down. So this is intermediate term negative. And then the weekly trend as well. We're going above the moving average. We haven't come up to 20 yet. So it's not a confirmed trend, but it is a strengthening trend. It's just not confirmed yet. And it's negative. Even though the red line came down, it's well above the green line, which did come up a little bit this past week. So we have short-term daily chart, intermediate term daily chart negative, weekly chart negative as well, which is longer term. Then we were really improving earlier in the week. This is a measure that I use to look at what is the condition of the short-term trend. I use a 20 period moving average for the short-term trend. We were starting to come above it. The blue line and the green line were starting to turn up. Well, then we lost that. We came down a little bit on Thursday, but we actually broke down below these lines on Friday, which is turning the lines back down. This is some of the damage that we saw in Friday's session. Then we look at the condition of the intermediate term trend based on 50 periods. We came right up to this double exponential moving average based on 50 periods. That provided overhead resistance, and now we're falling back down. This is still negative. All of the regular moving averages, and I plot a simple moving average, which treats all time periods the same, and an exponential moving average, which weights it more towards current price. We're below all the moving averages here. We were able to regain the 200-day moving average, then we lost it. That's not very encouraging. First of all, that we broke through it in the first place, and then we came back up. We actually got back above it, and now we're down back down below it. That's not really good for the market. Now, we could always recover from here. And a lot of people are looking at charts over this weekend going, oh my gosh, it's going to get ugly. It could get nasty, which it could. But if you have enough people that think it's going to get ugly and nasty, that's usually about the time we start bouncing up. Then this is also negative. We're well below the 20, 50, and 200 period moving averages. Well, according to the boom indicator, we're kind of far away from those moving averages. This is an oscillator. When we fall down to an extreme reading, we have a tendency to bounce back. And we see those readings now with the 20 and the 50 period moving averages. So it's negative, but we could bounce from these readings, but you could see just recently, we could also go a lot lower than where we're at right now. And we broke through support with the anchored moving averages. I was really following along with this light blue line. On the way down, that broke through. Then it was providing overhead resistance. We got back above it. Then on Friday, we broke down below it. And this is an anchored moving average going back to the low set almost a year ago. It was April 2024. And that's fairly significant support that we lost again. Now we're going to be watching this purple line. This goes back to another significant low that was set in October 2023. And that was a pretty significant low. If we keep falling, we'll be seeing if this ends up providing some kind of support. We may not even get down here, but if we do, we have some things that we're already watching for. And then the growth to value, this is where we're seeing a lot of the damage done. We're seeing rotation out of growth into value. That's why we're seeing this ratio going down. If growth was being favored, this ratio would be going up. It's going down. It was showing little bits of promise along the way here. Well, that was pretty much taken out the latter part of this week, where we're now going back down with this. This is another intraday chart showing that the blue line is below the red line. If growth was outperforming, the blue line would be above the red line and going up instead of below the red line and going down. Then we look at mid cap growth to value. We're down below the 200-day moving average. Small cap growth to value down below the 200-day moving average. S&P growth to value. These are end of day charts, not intraday charts. Also back down to where we were before. Not looking very promising right now. And we're also looking more negative with this growth to value ratio. These two ETFs, we're trying to bounce back up, trying to show some improvement, and then just gave all that up in Friday's session. Also looking at continued weakness with discretionary versus staples down below the 200-day moving average with the ratio. Discretionary is more growth, staples is more defensive or are more defensive. And the fact that this is going down is more negative for the market. And our growth to value ratios going down with the Qs to S&P, discretionary to S&P. See, these were showing some improvement here, but then they got just decimated in Friday's session, especially when we look at large cap growth to large cap value. And we're going down here with large caps, mid caps, and small caps. So pretty much market wide right now. This is also negative. It was turning more positive. We came down below this 25 area, which is generally meaning the market is capitulating, that everybody's freaked out. And a lot of times we can V bounce out of this. And we've done that recently. Well, we came down here below 25 and just camped here for a number of weeks. We started to break back above it, and then Friday happened, and boom, now we're back down below 25 again. And we could still go lower, and we could stay here for a while. Or we could just thrust up out of this. We don't know what's going to happen there, but we're just watching this to see how it plays out. This is negative, but it could also be positive. But I showed this a week ago, where those people that give recommendations for things, they write newsletters or they have websites that they operate, they are extreme negative. They improved a little bit. We're a little bit over 1. They were at 0.8 something a week ago. So it's coming up just a little bit, but this is still quite a negative reading. When everybody's negative, that's usually when it's a good time to be positive. But we've been at this place now for a couple of weeks, and it doesn't seem to matter at this point. I wouldn't use something like this independently. I would use it in conjunction with other charts. All right, and then for the 5th week now, we are seeing individual investors extreme negative. Now, there was another chart that I posted earlier in the week that said when this survey right here spends 5 weeks under 50, which we've been well under 50 now. We're at minus 24. We were down in the minus 40 area there for a while. When that happens, it's 100% up with positive return since, after that happens. But again, I wouldn't use this chart to make decisions off of. I would just use it as part of information and then see if other charts are actually confirming that we're starting to bounce with any real significance, because we've had a lot of false alarms over the last couple of weeks. This is what they're blaming for sparking things selling off in Friday's session. The blue line, this is consumer sentiment, and it's really coming down. Folks are just really rattled right now with the new administration. They may like what Trump is doing, but they're unsure what's it going to do to the economy? What's it going to do to inflation? Or they may hate Trump, and this just confirms why they should hate him. So we just kind of have to see how all of this plays out, because it's probably one of those things of short-term pain, long-term gain. At least that's what President Trump is trying to do. We don't even know if what he's going to do is going to work with all these tariffs and things like that. But it's causing a lot of ruckus and a lot of uncertainty in the markets right now. And if you have a sizable portfolio or a lot of cash that you want to come in and buy, you're not going to put all that money at risk if you're not really sure what's going to happen, if you don't have a lot of confidence about how things are going to play out. So that's also feeding into consumer sentiment. Are they feeling good about their job? Are they feeling good about inflation, about the economy? No, they're apprehensive. And we're also seeing this going back down. This is the risk on to risk off ratio. When the market's positive, this goes up. When the market's negative, it goes down. It was starting to improve, but then boom, really came down in Friday's session. We're back above 20 with the VIX. That's where we see negative annualized returns. This is the line chart, which is the closing value, and the bar chart, which is the open, high, low, close. And we're now negative across the board here with our advanced decline lines. We dropped below the moving average based on the S&P. Now, this is a different moving average than when I showed the advanced decline line at the beginning of this video. This is a little shorter term, but we've been holding out above this, and then we finally broke down below it on Friday. We were already below it with the NYSE common stock, mid caps, and small caps. And this is smart money indicator number 2, where this one's negative. The histogram is going down and the red line is starting to go down. So smart money indicator number 2 is negative. Smart money indicator number 3 is the chicken oscillator. It's going down. And that's one of these, or the second one and this one are the indicators where I use the direction of the indicator to determine if it's positive or negative. Where accumulation distribution, I tend to use is at above or below the moving average. And we're negative here. The vortex, the red line is going up, but the green line is going up as well. We were getting very close to seeing a positive cross here. That was after Wednesday, but it just didn't see any carryover into Thursday and just kind of got blown out of the water on Friday. And we were improving here with those stocks inside the S&P above their 20-period moving averages. We actually crossed back above 50, which turns this positive. Yep. Now we're dropping back down below 50. And we're turning back down with the summation index based on price and volume. That's now negative where it had been positive. And we look at the NYSE summation index going down based on price and volume. That's a broader market measure that's now negative. We're going down with the swollen trading oscillator based on price, and we've already crossed below the midpoint based on volume. That's negative. And we've turned negative after Friday with the parabolic SAR on the daily chart. And now for the last 4 weeks, we've been negative on the weekly chart. So we're seeing more confirmation there, longer term. And we were looking positive with the bullish percent index. Nope, not after Friday. We came down, dropped below the moving average, and have turned negative. We're also seeing a decline with the NYSE bullish percent index as well as the NASDAQ 100 bullish percent index. And we saw some O's drawn in after Friday. That's a negative thing. X's would be going up. O's are what's going down. So that's also negative there. And we were trying to get back above this 61.8% retracement. No, we fell down below it. That's the negative side. The positive side is we're still above this 50% retracement level. Now, if we keep falling, that's going to turn things more negative, and we may go all the way down to this 38.2% retracement level. So the market is looking rather vulnerable right now. And we were looking more positive here. The Staples to S&P ratio, when this is going down, that means the Staples are underperforming the S&P, and Staples are defensive. Well, in Friday's session, we really spiked back up, totally blew out of the water this positive sign that we had been seeing. And this is longer term. I only show it in this video, and then I show it in the what I call the deep dive video because we didn't get any signals on this charts in 2024. The last one was late 2023, and now we're getting another signal dropping below the red line. This is a long-term oscillator called a special K, and it is negative. And we're looking more negative with the total US stock ETF. We were starting to recapture the 200-day moving average. Well, we lost that. And these are micro caps. These are even smaller than small caps. They're just seeing a death cross here. We've already seen a death cross with the small caps. And there are two small cap indexes that I follow, the S&P 600 and the Russell 2000. Those are negative. Now we're starting to see a death cross here with the even smaller stocks, the micro caps. The financial sector, the only reason it's on the negative side is that we dropped back below the 50-day moving average. But this is still in an uptrend and still holding up for the most part, and we want it to. We don't want to see it fall apart like we did going into the great financial crisis. But since we're under here, we did get hit pretty hard in Friday's session. This is a little bit more of a concern when we look at the regional banks, which are the smaller banks, and compared to the financial sector, we're still going down here, and we just saw a recent death cross with this ratio. And now we're just waiting to see, is there going to be any news that comes out that says, yeah, XYZ small bank somewhere USA is saying that they're having trouble. I mean, that's what we heard with Silicon Valley Bank, Republic Bank, New York Community Bank. We're just waiting to see if other banks are going to start having some problems or if this decline that we're seeing is just a matter of the ups and downs of how markets move. The FANG index was hanging out around its 200-day moving average. Now it's dropped below that. And we're seeing a little more weakness here with the stock to bond ratio. When we're above this and going up, that means the market's anticipating a soft landing, meaning no recession. We're dropping down. We were looking a little bit better here. We got up to the lower end of the rainbow, and then we fell down. Now, a hard landing means that we might go into a recession. Now, we haven't been really screaming down here yet, and we could still recover from this. But the longer we stay under here, the more these lines are going to roll over. And if this keeps declining, the more it looks like we, at least the market, would be anticipating that we're going into a hard landing or a recession. And of course, everybody has their opinions about what's going to happen. I watch the charts, and there are other charts that I post on the website from time to time, and just to give us an update. What I'm really watching is the employment situation. As long as that stays strong, it's very unlikely that we will go into a recession. And we're going to get the latest employment situation report in the upcoming Friday, April 4th. This is also showing a bit of a change here, a little bit of a concern. This is the same chart that we looked at, but instead of stocks to bonds with the ratio, this is bonds to stocks, showing how bonds have been underperforming and now starting to outperform in the short term. Then the tech sector, the 3 to 7 year bonds below the rainbow and declining. And I have about 10 different charts that would show you the same thing. So I figured I would just limit it to a few. This is actually more negative, and this is one of the first areas to turn more negative back in late 2024. Home construction to bonds. This is a very interest rate sensitive area. This continues to decline. And this is a big area for tech. The semiconductors, this was the last index that I follow that actually turned negative. And you notice back in early 2023, because we bottomed in October 2022, this was the first to really signal an uptrend, and we've been in this uptrend since that time. Now we're starting to see a death cross here for a downtrend. So this is something to be concerned about. Long-term chart of the NASDAQ 100 still underneath this trend line, going back to 2009. And we're seeing the semiconductors, that's more growth, to Dow, that's value. This continues to go down. It's not going down with a lot of conviction, but it has been declining. And we've been watching this chart go down for quite a while now. And then there's this thing called the Hindenburg-Omen, and we don't have a confirmation yet. And if you want to know if we're going to get a confirmation from that, please watch the daily video that I update. So what are the areas that I'm watching? All right. We've been below average with volume. There was one day, it was a week ago Friday, and it was the quarterly expiration for options. And so we saw massive volume on that day. But even when we're going down, even when we're going up, we're seeing below average volume here. That's showing a lack of conviction. People don't want to put a lot of money at risk right now, and so they're just kind of waiting on the sidelines. This is another percentage area that I'm going to be watching. We set the all-time high in the middle of February, and then we came down and we were down just a little bit more than 10%. Now, I do it a little bit different than what you may hear. Usually it's close to close, and when we close down 10%, that's when we go into correction territory. Where I do it from the intraday high down here to the intraday low, so my percentage is a bit bigger than that. Well, it looked like we had a successful test. We came down about 10% and then we came out of it. Well, now we're coming right back down to it again. So if we go down and we break below this previous low, that's going to be quite negative for the market. If we can somehow turn around and go back up, that would really help things an awful lot. And then this also measures on a closing basis, we're 9.17% from the high that was set in February to Friday's close. So getting close to that 10% level. We want to keep an eye on weekly jobless claims. So far, this is holding up. And this is giving the market confidence that maybe we're not going to go into a recession. But if we see this really start to spike up, especially with all the government layoffs, the Doge is going in and finding, that might spook the markets a little bit. But so far, these things are holding up for right now. And then the continuing claims are going up, but they're still in the basic range that they've been in for quite a while. We're going to be looking for a real spike in this to see if the employment situation is getting weaker. And then this is the mass index. We're waiting to see if this line crosses down below the red dashed line. This is trying to signal a reversal in the market. And we're just waiting to see if that's going to happen. And we have another signal here from the Pring bottom fisher. This actually generated a buy signal after Friday. But again, I wouldn't use this independently all by itself. I would wait to see other confirmation. But we were getting close to a buy signal right here about the beginning of March. And then it started to come down. Well, now we have another buy signal. This was almost a buy signal. This is an actual buy signal that's now being generated. That's why I have it in the watch area, because I don't want to necessarily go positive. There have been times when this has given us a very good signal. There's been other times when the signal has just been horrible. All right, and I don't know whether to treat interest rates positive or negative now. They're just kind of chopping around. I guess as long as we stay under the 4.5% level up here, which would be a 45 on this chart, that could be considered positive. And we're keeping an eye on this, the spread between risky and not as risky bonds. When this is coming down, that means the risk is increasing. And then we started to improve, and then boom, we came back down in Friday's session. If this continues to fall, that's going to be more negative from a sentiment basis for the bond market, which could have some impact on the stock market. And then we're watching the relationship between different kinds of bonds here to see, okay, a lot of people are freaked out about inflation. What's the market saying about that? We can go with whatever opinion people are saying. Well, let's look at some proof of what the market is actually showing us here. So first of all, we look at cash versus 3 to 7 year bonds. Now, if this was going up, that means you want to hang on to your cash. You don't want to lock it up into these 3 to 7 year bonds, because if interest rates are going up and inflation's going up, you'll get a higher rate of return. So that's why we see this ratio going up. Cash is outperforming bonds. Then when this is coming down, that means that there's less uncertainty or more certainty about inflation and interest rates, and that's more positive. Well, we've been coming down now. Now, we're still in an uptrend with this overall ratio, but we're not really seeing any big action. Now, this is shorter term. This is 1 to 3 months to 3 to 7 years. And I'm going to go further out from here. Next, we look at TIPS, which are Treasury inflation protected securities, and they adjust for inflation and interest rates. So if inflation and interest rates are going up, people want to get into TIPS, and we'll see this ratio going up. If they feel that inflation and interest rates have topped out and they're going to start coming down, that's when we see this ratio coming down. Now, we're seeing a little bit of a pickup here, but it's not all that drastic, at least at this point. So there's not an awful lot of concern, but a little pickup of concern based on what we saw this past week about inflation and interest rate concerns. Then we go from TIPS to 7 to 10 year bonds. We go a little further out. This had been declining, but it did shoot up this past week. If it keeps going up, that's going to cause some more concerns for us about inflation and interest rates. If this starts to come down, that means there'll be less concern about inflation and interest rates. We're keeping an eye on the 10 to the 3-month yield curve. It's now back to being inverted again, and it kind of goes inverted, then it drops back to being normal, then back to inverted again. So we're just watching this. And we want to keep an eye on oil. It's still below that $70 level. And we want to keep an eye on the dollar. It's still below its 200-day moving average. Thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.